Welcome, my friends. Big companies are filing for bankruptcy left and right, and it's just the beginning. Rite-Aid is now set to close about 60 stores, with more likely to come. Rite-Aid is closing 63 of its stores, a process that began in November and is expected to add $25 million in annual EBITDA, the company said in its latest earnings release. The closures are part of a process aimed at cutting costs, adding profits and ensuring Rite-Aid has a healthy foundation to grow from, with the right stores in the right locations, for the communities it serves and for our business, Rite-Aid CEO and President Hayward Donegan said in a statement. Rite-Aid added that it will continue evaluating its footprint over the next several months and expects the closure count to increase as it finalizes its plans. But some Wall Street analysts are predicting that Rite-Aid will be forced into a bankruptcy filing. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the doctor knows the patient identity. Rite-Aid has struggled for years now to get its financial affairs in order as it competes against its larger drugstore rivals. It hasn't posted positive net income from continuing operations since the fiscal year covering 2016. During the pandemic, when drugstores became a convenient shopping venue and critical health service providers, those losses shrunk, but still remained above $100 million. This year, however, losses are surging again. In the third quarter, the company's net income fell from $4.3 million last year to a nearly $36.1 million loss this year. For the first 9 months of its fiscal year, losses have more than doubled compared to last year. Given that, it's no surprise Rite-Aid is shrinking its footprint, which currently stands at more than 2,400 retail pharmacies. Yet the company raised its expectations for the fiscal year and said that adjusted EBITDA rose 12.7% from last year. A little over a year ago, the drugstore retailer launched a rebranding effort that included a new logo, a focus on holistic health and a retooled website. The company also announced a pilot concept for a store of the future. In September, executives said they were still testing store remodels and new concepts. Smaller pharmacy chains have had a rough go of it in recent years. Fred's and Shopko both liquidated in bankruptcy within the past 3 years, while Rite-Aid has struggled to stem its losses. While much stronger financially, Rite-Aid peer CVS also plans to close a significant chunk of its store base, 900 over 3 years, to be exact. The drugstore giant said it was evaluating changes in population, consumer buying patterns and future health needs to ensure it has the right kinds of stores in the right locations. Global Data's Neil Saunders described the coming closures as a savage and wholesale trimming, and said the move underlines how far the rot has set in because retail has been a neglected part of the business. Rite-Aid announced the closure of 145 stores last year and may close more in 2023. The retail pharmacist is deeply indebted, bleeding cash and struggling to compete with more formidable opponents like CVS and Walgreens. Rite-Aid hasn't had a profitable quarter since the fourth quarter of 2019. According to its latest earnings report, Rite-Aid lost roughly $750 million in the 53-week period ending March 4, 2023. Though the company reduced expenses year over year, from $25.1 billion to $24.8 billion, it generated less revenue, from $24.5 billion to $24 billion. Worse, Rite-Aid expects even less revenue in 2024, from $21.7 billion to $22.1 billion. As Rite-Aid's profit margins continue to sink, its short-term debts are nearing maturity. Its 2025 senior notes have an outstanding balance of $320 million, while loans and bonds amounting to $2.9 billion come due in 2026. Even more concerning for investors is the opioid prescription lawsuit. The U.S. government is suing Rite-Aid over concerns the company knowingly filled hundreds of thousands of prescriptions illegally between May 2015 and June 2019. Imagine that the government wins. Just where will Rite-Aid come up with settlement money? Not from its investors. Rite-Aid's stock has hit all-time lows in 2023. Its current share price, $2.16, is roughly 91.3% below its initial public offering, or IPO, price of $25 per share. To put that into perspective, consider that the company launched its IPO in 1968 and had its highest share price of $993 in January 1999. In April 2022, Rite-Aid rejected a buyout offer from the private equity firm Spear Point Capital Management for $815 million, at $14.60 a share. Since then, the company's market cap has dropped from $428.4 million to about $122 million. 6 other large companies threw in the towel within a recent 48-hour span, the most active such period for bankruptcies since 2008, according to Bloomberg data looking at companies with at least $50 million in liabilities. Rite-Aid has been experiencing financial problems. The company reported a quarterly loss of more than $300 million for its fiscal 2023 second quarter ended August 27 of this year compared to a loss of $100.3 million a year earlier. The company has also reported a loss of more than $241 million due to store closures and the loss of COVID-19 vaccine and testing sales. Rite-Aid's worse-than-expected Q2 loss stemmed primarily from a goodwill impairment related to its pharmacy services segment. The company remains highly leveraged and has a yellow flag for a potential bankruptcy filing. Rite-Aid was founded in 1962 in Scranton, Pennsylvania by Alex Grass under the name Thrift D Discount Center. After several years of growth, Rite-Aid adopted its current name and debuted as a public company in 1968. The company ranked number 148 in the Fortune 500 list of the largest United States corporations by total revenue. The COVID-19 pandemic has disrupted the global economy and triggered a wave of large corporate bankruptcies. In particular, the number of mega bankruptcies, over $1 billion in reported assets, increased dramatically in the second and third quarters of 2020. A decade of cheap money instilled a false sense of invincibility in business executives and private equity managers who forgot that bust normally follows boom. Now, a combination of weakening demand, rising interest rates and the end of government stimulus programs is exposing companies that were already struggling before the pandemic. The opioid epidemic has been a major public health crisis in the United States. And Rite-Aid seems to be in the crosshairs, along with other companies. The opioid crisis refers to the widespread misuse and addiction to prescription painkillers, heroin, and synthetic opioids such as fentanyl. The opioid epidemic has been fueled by the overprescription of opioids by doctors and the illegal distribution of opioids by drug dealers. In response to the opioid epidemic, many states have filed lawsuits against pharmaceutical companies that manufacture and distribute opioids. The lawsuits allege that these companies engaged in deceptive marketing practices that downplayed the risks of addiction and overstated the benefits of opioids. So, Rite-Aid has risks from a number of sources. The Federal Reserve's interest rate hikes, designed to rein in inflation, have laid bare the market's weak hands. A credit crunch is here, and it's spreading quickly, crippling companies with large, cumbersome debt loads. For those looking to refinance, the ship has sailed. A look at the other recent bankruptcies from recent days shows a consistent theme: exorbitant liabilities, mostly in the form of debt. It's worth noting that a bankruptcy filing is not necessarily a death knell for a company. Bankruptcies tend to wipe out stockholders, and give companies an opportunity to restructure their debt and come out the other side with a healthier balance sheet. Still, an uptick in bankruptcy filings clearly demonstrates increasing economic stress. Data from Moody's suggests that the bankruptcy trend is just getting underway. The ratings giant expects defaults for companies with speculative-grade debt to rise to 4.9% by March 2024, up from 2.9% at the end of the first quarter of 2023, and exceeding the long-term average of 4.1%. S&P Global's reading of the situation isn't much more promising. It sees the default rate for junk-rated companies getting to 4% by year-end, more than double the 1.7% figure from the end of 2023, though still off the peaks of the post-COVID era. A separate look at private bankruptcy is arguably even more troubling. As of early April, UBS found that private filings were outpacing even the early stages of COVID, when many firms went under. A 4-week moving average of 7.8 registered in late February handily exceeded a comparable figure of 4.5 reached in June 2020, the firm found. On a specific industry basis, the financial sector is under duress following the collapse of Silicon Valley Bank, with multiple other institutions following suit in recent weeks. Retailers from Bed Bath & Beyond to David's Bridal have filed for bankruptcy in recent weeks. Envision Healthcare, a medical staffing company backed by KKR, was one of the 6 firms to declare alongside Vice. What this assorted list shows is that no industry is safe from balance sheet bogeys. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.